Hi, I'm Scott Sherman. I'm the founder of Toros Equities. Today, I'm going to have a conversation with Brian about investing in retail and office and looking for opportunities in the distress of what's happened in those two areas and how to potentially make some money and find some opportunities looking forward.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 527. Billions of dollars in office and retail buildings are trading at deep discounts. And while most investors see that as a warning sign, my guest today sees it as the biggest opportunity of this market cycle. Scott Sherman is the founder and principal of Toros Equities, a Miami-based firm known for acquiring and repositioning distressed office and retail assets. Today, we'll talk about how he's finding value where others see risk, and what kinds of office and retail spaces will survive this downturn, and why distress may be the smartest play in commercial real estate right now. Scott, welcome back to the show.
Thanks for having me on.
What are you seeing now? I mean, what is going on in the retail space and in the office space?
So I'd say, look, on the retail side, retail's been very, very favorable. I think, even since we last spoke, institutional capital flow into it. I think cap rates have continued to stay competitive. And so we haven't seen as much distress on the pure retail side, especially down here in Florida. But there's definitely some out there. There's been some select, deals that actually one we're currently pursuing, another one that we acquired about a year ago. Specifically, the one we acquired, just as an example, was on Lincoln Road, which is prime high street in South Beach in Miami. And that's kind of like a unique animal in that I think when you look at South Florida retail, it's thriving. But South Beach kind of got ahead of its skis and has gone through a real kind of reset there over the last, call it 5 years. And so I think now is an interesting time where you can come back in. There's a basis reset happening. There's a big portfolio that's owned by Morgan Stanley and Terra Nova on Lincoln Road that actually they acquired. Morgan Stanley bought it, I want to say like 6 or 7 years ago for north of $300 million, just to give you an example. And it's in contract to sell, not to us, but it's in contract to sell, and that number's south of $150 million. So just to kind of show you, so there is still some distress and some value out there. The one we bought was actually a building that much smaller scale, but on the same block. The prior ownership bought it in 2013, so 12 years ago, for $19 million, and we just bought it for 10.5. So same thing. So there's a reset happening. We're seeing some value and opportunity there. It's obviously been a little, few and far between, but we're seeing some things like that. I'd say the office side, though, is where it's been a lot more interesting, especially for distress and opportunity. And I think I was, pounding the table a little bit last time we spoke, how we've been leaning in very hard on the office story over the last 3 years. Particularly, we didn't think office, especially in Florida, but in a lot of markets, is not as bad as everyone says. Institutional capital has been on the sidelines. And so we saw some real opportunity and leaned in, put our money where our mouth is. And, we bought over 1.5 million square feet of office the last few years, actively pursuing several. But I think what's changed is that I think people are finally waking up and realizing not all office is bad. And you're starting to see more people come back into the space and feel like now is the time that they can start to dip their toes and start to look at office again. And so just since the summer alone, we've ended up in a couple competitive bidding situations on office, which we haven't seen in years. And are seeing some institutions starting to kind of kick the tires and dip their toes back in. And, we haven't seen institutions looking at office like this in a while. So I think it's encouraging, but also now creates more competition for guys like us who are early.
Remind me and our listeners the type of retail that you are acquiring, that you're out there making offers on, picking up, turning around. And give us an example of a project that you're either working on now or that you've done in the past year and a half.
So most of what we look for is existing value add retail and kind of good urban areas, dense areas. We're very active kind of buying up downtown St. Pete, retail. We've done some stuff on Lincoln Road, and we own throughout South Florida different retail.
When you say retail, though, are you talking like strip malls?
It's more unanchored strip malls and kind of retail, like kind of think of like single story retail in these kind of downtown kind of corridors where it's more high street type retail, they call it. We're not as much focusing and chasing like grocery anchored shopping centers and power centers. And the reason for that is there's still a lot of institutional REIT capital out there that's a lot cheaper than my capital. And we're not going to win bidding on a 6-cap public anchored center. So we're looking for more value and more kind of hair to kind of create value. So, we're seeing that in kind of these urban placemaking opportunities. The other big piece of our retail strategy, which is pretty unique, is we like to buy the retail condo, the ground floor retail component of vertical mixed use projects. And so we've done a lot of these where we've partnered with developers such as Related in Miami, Mill Creek, PMG, where we'll actually, when they're doing new developments with a big mixed-use retail component, which a lot of these residential developers really just don't want to deal with. They look at it as a headache. It's a necessary evil in a way, but they just don't know what they're doing with it. So we come in and we actually will forward purchase the ground floor component from them at groundbreaking. So now we're taking the lease up, all that headache or perceived headache of the retail off their hands, and that's what we like. So we're coming at a much better basis, and we look at it as we have a 2-year head start while the building's under construction to pre-lease the whole thing. Obviously, we got to buy at the right basis and in the right markets, but that's been a really good model for us. I'd say coming out of COVID, that pipeline really died off because new residential development just really kind of stopped. We're finally starting to see that pick up again. So down here especially, we're seeing more developers start to try to get things out of the ground, and we're getting a lot more inbound calls saying, hey, Scott, you want to look at our retail? We're trying to figure this out.
So rather than buy existing retail, you're also now getting in at the beginning of development on mixed use properties. Are you condoing off the ground floor and paying for it up front, or like how do you structure a deal like that?
There's a few different ways you can structure. It's a good question, right? So there's not one way. And we've kind of, I don't want to say we have a playbook, but we have like almost like a menu of a few different structures. And so I'd say the basic is, yes, you basically create a condominium structure. We're basically just like someone wants to forward purchase or buy a residential condo pre-construction. We're buying the retail condo pre-construction. Same idea, right? We're going to put up a hard deposit on groundbreaking. Now, because we're talking bigger numbers, we need to make sure they have their capitalization in place, their completion guarantees in place, and things like that, so that we know the developer is going to build the building, because that's our risk, right? But yeah, we put up a hard deposit and then we close upon TCO when the building's done. So we're not actually building it; we're forward purchasing it, and then we'll do the build out and the lease up. The only ground up project we're involved in right now, and I'm excited about this one, but it's a little bit out of what we typically do. Is we're doing a 200,000 square foot retail lifestyle center ground up in Bonita Springs, which is just north of Naples. And we actually just had the groundbreaking ceremony last week on that. We're going vertical. And we were actually brought in through a developer who really bought an entire site for a mixed use with residential, office, and retail. We kind of bought into the retail component as their partner to really help curate and get that project off the ground. It's been a lot of fun. We've already got a lot of tenants lined up, including like a Chick-fil-A, Chipotle, Panera Bread. We've got a TJ Maxx and Ulta deal. And so we've got a lot of interesting things going on there. But again, we're not the lead developer. We're really a partner with the development group. So we kind of know what we're best at and what we're not best at, and try to stay in our lane.
So you just mentioned some, top retail tenants like Chick-fil-A and whoever else you mentioned. But how do you line those up? I mean, that's a whole skill and an art right there, is to say, okay, we like this retail location. It's brand new. We're gonna condo it out, and we know we can fill it with these different tenants. Like, what gives you that confidence? What do you have in place that makes that a reality?
I like to say, leasing and curating retail is more an art than a science. And it really is, right? Because you've got a blank canvas in different markets, and what we do is, I have a great team. We have a lot of experience and relationships throughout our career on the retail side. But yeah, you got to sit down and look at every property, the spaces, what kind of tenants would fit here, who would be the right types of tenants for this project, for this location. And then we go out and we target them. And we go and through our relationships, we get in front of them and say, hey, here's a site we want to, we're developing or we're partners on. And here's why we think it would be a good idea. And then really it's on us to sell these retailers on why this project makes sense for them and why they're going to make money there.
Do you have your own brokerage in-house, or do you work with external brokers depending on the location?
We're really unique. We don't have like an in-house third-party like tenant brokerage. But what we do is we like to engage with all brokers in the market. So we kind of usually I have someone on my team who really oversees all the retail leasing. And then he'll basically work with all the brokers so that we're basically casting a wide net and getting every tenant lead out there by working with everyone versus just having one brokerage shop with an exclusive. So we do it a little differently in most markets, but it's been a good recipe because we have our relationships, and then we're kind of, offering what I'd say is probably better compensation structures to brokers because there's no exclusive that they share it with.
Sticking with retail for this question, you talked about institutional money and how you really can't compete with institutional money. So you're finding opportunity where institutional funds aren't looking. Where else are you seeing that opportunity right now?
So, well, let me clarify that. So it's not that I can't compete with institutional money. We work and partner with institutions, but specifically on like the core type stuff, which is like the grocery anchored and the power centers, there's core institutional capital out there that'll buy those at such tight yields that there's no value, there's no money for operators like us to make. So on that type of specific asset type, we really can't compete. But I think there's a lot of other avenues, such as an office or in some of this unanchored retail space where there's less institutional competition or where institutions need operators like us to buy it, right? So if they're buying a stabilized grocery anchor center, they can do that themselves. It doesn't take a whole lot of brain damage, right? But to buy a vacant, hairy value-add repositioning, they're going to want a local, partner that has the expertise to work that asset. And the same on the office side, right? Office is a very, that's an organism that you really have to really work and stay close to and understand, or you can be losing tenants pretty quickly. So I think, on those types of deals, we provide a value for the institutions to partner with them.
What's a good retail example of a project you've done in the past year or so that you've been able to acquire at a discount and do some value add and turn it around?
So I say in the last few years, I'm trying to think of a good one that we've done. Well, there's one that we have I mentioned the Lincoln Road deal, which I think is a good one. That was a great one where we bought it really well. But we bought a retail condo. This is a forward purchase from a few years, but we closed in the last couple of years in Wynwood. So it was a big retail condo below a residential project in the middle of Wynwood, which is a really exciting, dynamic, and growing neighborhood in Miami. And so on that one, we've been leasing and curating that property for the last few years. And that same thing, we put in Starbucks, we put in Chipotle, we've got a few other local brands that you would know. We've got some fitness. We're still leasing, so it's not 100% leased. But on that one, we bought it really well. We've been doing well in the execution. And then what's unique and interesting about this one is we had a tenant in a small space there. They were an ice cream gelato concept. And they reached out to us and said, we want to buy our space within the condo. And we're like, well, it's a little complicated to go down condo to condo and create smaller ownership structures. So it's probably not worth it. And they came back and said, okay, well, what if we paid you X? And that number was such a crazy number that we couldn't say no. And so we basically were like, okay, let's go through the motions if they're really serious at this number. And fast forward, they closed 2 weeks ago. I was skeptical they were going to show up to the closing table because just the number to me was a pretty strong number, but they closed. And so what that did is it really set a comp for us for the rest of the property, because now that price per square foot on the sale is going to look good when we go to sell the rest of it, down the road. And what we did is we had a loan in place, and it was that little space, just to kind of give you some numbers here, was about 4% of the rentable area of the entire retail condo. So we sold them that small little space, but the proceeds from that we used and basically went to the lender and said, hey, we're not going to put it in our pocket. We just want to pay down the loan and lower our leverage. And it basically paid off 25% of the loan with 4% of the rentable area. So it was a good sale.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Where do you line up your capital? I mean, are they local banks? Is there larger groups out there that will finance these types of deals that you're doing?
On the debt side, I'd say we kind of, every deal's different, but we'll kind of run, we have our relationships with some local banks, but depending on the deal, sometimes it's debt funds, sometimes it's someone I've never heard of, a credit union. So we'll work with local debt brokers to help us find the best debt. And on the equity side, it's always been more high net worth family office type capital, and then some institutional capital depending on the deal. But we kind of pride ourselves on the high net worth family office type capital. It allows us to be a little bit more nimble when we're doing deals. We don't have a finite hold period like a fund would. So if the thing requires a longer hold period, we have that ability. But overall, the debt's been, I'd say, especially now, it's getting even better with rates coming down, but there's definitely a good amount of capital out there on the debt side.
Let's switch over to office, because you're also working in that space, and you said a few things about it at the beginning of this conversation. But certainly right now, as we speak, at the end of 2025, we're seeing some green shoots of positivity come out in the office space, and it does seem to be localized, like on a region by region basis. But what are you seeing, and where is the opportunity that you're going after right now?
We're seeing a lot. I'd say the opportunity for us is buying, I think, well-located and good office assets. They don't have to be brand new. They could be a little bit older, but ones where we see there's a relevance to them being office and continue to stay office, either with good tenancy or good opportunity to reposition it. So, we're active in Miami, Fort Lauderdale, Palm Beach. We have some things in Tampa. One in Nashville, one in Atlanta. But, for the most part, our focus has been staying closer to home in Florida. And, in January of this year, we actually, I say one of the best or more exciting office deals we've done in a while is we bought the debt on an office building, a Class A building that was built in 2019. So a pretty new building, high quality building. It was in distress. We bought the loan, foreclosed on the borrower. This was back in January, and now we cleaned it up, and we're already moving forward on a contract to sell it. And we'll probably sell it a year and a day from when we closed on it, and it'll be north of a double in a year. So that's going to turn out to be a pretty good deal if we, soon we get it closed. But trying to find more of those right now. It's been few and far between because we're being very disciplined and patient. But there's a couple really interesting deals that we are actively pursuing right now on the office front that, I'd say maybe the next 30 days, hopefully we'll have some good news on those, but we're not quite there yet. But we're actively looking and seeing things.
The example you just mentioned, you kind of glossed over the fact that you cleaned it up. What does that mean? You cleaned it up to add so much value to it?
The building was in distress, right? So it was in default. So the vendors weren't being paid. The leasing wasn't really being handled well. There were liens on the property. It was a lot of just issues, more management issues, right? There's a great asset, but I'd say it was just, the management side was not being handled very well. And I think a lot to do with the fact that they didn't have the capital to put in. And so, we came in, we closed, we cleaned up the liens, we settled with a lot of the, vendors. We fix and improve a lot of the issues that everyone was upset about. Now all the tenants are happy again. Now we're renewing tenants and, increasing the rent significantly. And, we kind of just, the building's now, I think, what it should have always been, but it was just kind of went through a little bit of a challenging moment in time, which we were able to take advantage of.
How much of that had to do with COVID and the fact that it, was built in 2019, right? When COVID, just before COVID hit, versus just the management issues, like poor management?
This one was definitely more of an operational issue. The building was 100% leased when we bought the loan. So it wasn't a leasing issue. It was really an operational issue. And to me, that's the better one, right? There's nothing wrong with the building. It's just someone needs to come in there with new capital and reset the basis and fix it. And we like those stories a lot better than, buying a fully vacant building and which we did actually. So I said the next best office deal I've done was a vacant office building we bought in November of 2020, right in the heart of COVID. And that was in Wynwood, in the neighborhood I mentioned before. But, same kind of story, right? We saw a brand new building that was built. It was vacant. There was one tenant in the building. It was Spaces, which is IWG, the Regis co-working guys. And they were in bankruptcy. This is in COVID, they filed bankruptcy. So we had one tenant in the building, and that one tenant was in bankruptcy. So not the best tenant to have in your building. But we were buying it for a significant discount to what it was just built for. We believed in the market, but obviously buying a vacant office building in November 2020, people thought had three eyes. We had to sign personally on the debt just to get anyone to finance it. But we're willing to take that bet. And I'd say within 18 months, we had the thing pretty much fully leased, and we sold it for a really good return. So sometimes you got to just see through the noise and, look where other people aren't and have a little conviction on it too.
How often do you see that management problem that, is really affecting the profits and the revenue of a building and creating that distress where you're able to come in? I mean, do you see that quite often? I
wouldn't say often. I'd say, look, as an operator, as a sponsor, right? Everyone thinks they can do it better than whoever they're buying it from, right? We can do a better job than them. And so, I say that kind of with a smile on my face, because there are good operators out there. I'm not going to say I'm definitely better than everyone, but I think we in the assets and the markets we're in, we understand when there's really some real inefficiencies going on with the property. They're not putting the capital to upgrade things, and we can just see there's a lot of deferred maintenance or visible kind of things that, look, you can walk into a property and pretty quickly anyone and notice, like, this looks like a building that the ownership doesn't care about. They're not putting money into it. This is one that some ownership really has pride in. They're really, everything's shiny, everything's clean, right? And so, there's even just those very superficial things, but it actually tells you a lot about ownership a lot of times when you walk into a property. So, we look for, and I also like to say there's certain, when you're buying from an institution, right? And they may, most institutions will probably agree, although they may not like when I say this, but I actually like buying from institutional sellers when they don't have a sponsor, when they're kind of owner institutional partners. Why is that, right? Most of the time, right, there's this office building sitting in Miami as an example, but they have an asset manager sitting in, Arkansas, overseeing this along with 17 other properties across the country. They don't know everything going on at the local level on a daily basis, where there could be an opportunity, where there's things they should be thinking about. So it's not that they're bad at their job or they don't know how to manage well, but they don't know. There's usually a little meat on the bone with those types of ownership structures, because they don't know every little thing going on in the market. So that's where we like to feel like we have an edge coming in and can create value pretty quickly.
So if you have someone sitting in New York looking at a spreadsheet, and you're in Florida and you look at the property, what do you typically see that they don't?
I think it just depends on the deal and what's going on. So I don't have that's a tough one to answer. But I'd say it's just when you're there every day, or you're there in that market every day, you'll just start to see things or understand trends in the market that maybe they aren't as visible to someone sitting in New York looking at a spreadsheet.
Talk about the trends in the office space and what the perception still is about office, and what you think it's going to be, what it actually is now, and what going into 2026, what you think it will become.
The perception's turning quickly, actually. It seems like, institutional capital's coming back in. You're starting to see some positive press articles on office again. It's starting. I think that the tide has gone out and it's starting to come back in. I think it's going to take some time. So I think there's still a window here to, for what we do to buy some good assets at good prices. But I think for everything we bought, I feel really good about the stuff we bought in the last few years, but wish we could have bought more. But yeah, I think it's going to continue to trend in the right direction. The capital investment into office is starting to come back, which I think is the first thing you need. And it's the institutions that really drive that.
And then looking forward in 2026, where do you see your efforts going toward? More retail, more office, a combination of both?
It's going to be a combination. I'd say, look, I'd like to swing the pendulum back a little bit, right? It's been so heavy office the last few years, as I mentioned. And I'd like to kind of swing that back and do a couple bigger retail deals in the next year. And like I said, I think that retail condo forward purchase structure that we've done a lot of in the past, that's starting to come back. So I think our pipeline with that type of structure next year should be pretty good. I wouldn't be surprised if we get 3 or 4 of those types of deals done next year, which would be great.
Scott, tell our listeners how they can find out more about you, get a hold of you, learn more about what you're doing.
We raise capital deal by deal. We're not a fund, so we're always sending out our offering memorandums to our investor database, which you can, anyone's welcome to join our database. It's you can go to our website, which is torosequities.com, TOROSEQUITIES.com. So there's kind of a double E in the middle there. But if you go to our website, there's a link there where you can click and add yourself to our investor database. I'm always accessible, so if anyone wants to reach out, my email is scott@torosequities.com, and I'm always happy to talk, or if someone has a desire to get involved in any of our projects, always happy to have a conversation.
How are you using AI in your business?
I'm embarrassed to admit it, but I'm not using it well. I know I'm not. I know I could be better at it. It's such a fast-moving and new concept, especially for, I guess, people from, that aren't, I'm not that old, in my 40s, but like I still feel like a dinosaur when it comes to this stuff now. And I'm trying to be better at it. I'm trying to figure out if there's maybe some sort of so I was at a breakfast with a bunch of people. I'm on the University of Florida real estate board. And this was a meeting for the board members that live in South Florida. And we were talking about maybe trying to organize a workshop. There's actually a professor that's really, really impressive in the AI space up at UF, and trying to see if we could set like a weekend crash course with this professor on how we can utilize it in our real estate businesses more frequently. So the answer is I'm not using it well. I know that, but I'm trying to figure out how I can use it better. But I'm learning every day.
Great catching up with you and finding out, what you're seeing there in the retail and the office space, and how you've been able to take some distressed properties and really make a nice profit off of them. And then also the ground floor new build condoization of the retail and the mixed use spaces. That's a really interesting concept. So thanks for sharing it with us today. It's been a real pleasure talking with you.
Same here, Brian. Thanks for having me on again.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.